If you are watching the news, you think the economy is safe.
They tell you the soft landing is here.
They tell you inflation is beaten. But if you look at what the bankers are doing with their own personal money, a completely different story emerges. While they tell you to buy the dip, insiders at major U.S. banks have been quietly selling off millions in stock. For every $1 of stock they buy, they are selling $40. They aren't investing, they are exiting. We are looking at a silent liquidity crisis that makes 2008 look like a rehearsal. The safety net that saved the banks last year, it's gone. And in this video, I'm going to show you the specific chart that proves why your savings might be legally locked away by mid-2026. This isn't a recession, it's a robbery. To understand why this crash is inevitable, you have to understand the mechanic they hid from you. Back in 2023, when Silicon Valley Bank collapsed, the Fed created a magical emergency tool called the BTFP, the Bank Term Funding Program. Think of the BTFP as a life support machine. It allowed banks to take their worthless underwater bonds and trade them with the Fed for cash at full value. It injected over $165 billion into the system to stop a panic. It worked for a while. But here is the problem. That program ended in March 2025. The life support was unplugged. But the patient, the banking system, is still sick. Banks are currently sitting on over $600 billion in unrealized losses. Without the BTFP, if depositors ask for their money back, banks have to sell those assets at a loss. They are insolvent. They are just hoping you don't notice before they can get their money out. Don't believe me? Follow the money. Let's look at the data. In the last 24 months, executives at major regional banks have sold massive positions. In some cases, we are seeing $25 million in sales versus less than $1 million in purchases. When a CEO sells stock to buy a yacht, that's normal. But when entire boards stop buying their own dip, that is a siren. They know that the Federal Reserve's quantitative tightening has drained the reserves down to the scarcity zone, barely 12% of assets. The plumbing of the financial system is dry. And when the plumbing dries up, the toilet backs up. That is what we are seeing in the repo market right now. So what does this mean for you? You might be thinking, I don't own bank stocks, I don't care. You should. When liquidity dries up, credit freezes. This is the credit crunch phase. Small businesses. Your local bakery or mechanic relies on revolving credit lines. Those get cut first, they go bankrupt. Jobs. When businesses can't borrow payroll cash, they fire you. Home prices. When nobody can get a mortgage because banks are hoarding cash, home prices don't just dip, they crash. But the scariest part, bail-ins. Since 2010, laws have changed. If a bank fails now, the government doesn't have to bail them out. The bank can legally take your uninsured deposits and convert them into worthless bank stock to save themselves. Your savings become their lifeline. I'm not telling you this to scare you. I'm telling you this so you can prepare while the masses are sleeping. Here is your 3-step survival guide. First, never keep more than the FDIC limit, $250K in one bank. Spread it out. Second, get out of the system. Whether it's gold, silver, or Bitcoin, you need assets that have no counterparty risk. Assets that don't rely on a bank's solvency to exist. Third, become essential. In a credit crunch, cash is king. Reduce your debt now before rates spike again. The insiders are exiting. The life support is off. The crash isn't coming in 2026. The mechanism has already started. If you want to know exactly which banks are most at risk, I broke down the warning list in this video right here. Click here to see who really owns the system. I'll see you there.